What's great about the asset class is they're almost exclusively issued by public companies that care about their credit. And so you're playing on the same team as management because they have target credit ratings and they'll issue equity or sell assets to maintain their credit rating. So we strongly believe that inflation is already contained, actually mismeasured, but contained, mismeasured by, not surprisingly, the BLS, which is kind of 50 years behind in how to collect data. So when you're older, what you don't want to do is say, oh, I'm going to be all in equities, all like NVIDIA and Broadcom. And then the market takes a big spill like it did during the tariff tantrum, and you need the money and you have to sell.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
I appreciate you taking the time to hop on, Jay. I think the first thing I want to cover with you is just a quick recap of what preferred equities are. You're kind of a preferred equities investor. You do some special and unique stuff on that, have been for quite some time. And it's a part of the market that not a lot of people talk about or consider or having in their portfolio or know what it is. And it's kind of this wonky tool, right? It's kind of, is it a stock? Is it a bond? Is it fixed income? Is it an equity? It's a dividend, but isn't it kind of like a coupon payment? It's this real interesting kind of wonky hybrid that's not quite either.
Well, I'm glad you brought it up. Thanks for having me on. It's really our favorite asset class because, when we talk about preferreds, we're talking about the listed liquid ones, which if you want to buy the individual ones, that's best for retail investors. It's difficult to trade their $1,000 preferreds. These are $25 preferreds. Mm-hmm. What's great about the asset class is they're almost exclusively issued by public companies that care about their credit. And so you're playing on the same team as management, because they have target credit ratings and they'll issue equity or sell assets to maintain their credit rating. Unlike private debt, not a lot of private preferred. We don't buy private preferred or rather preferred stock issued by private companies. So attractive from that perspective, good yields. The rating agencies, we think, over penalize the credit of preferred relative to the bonds, because if you have good credits, particularly investment grade credits, very low default probability, but the rating agencies say, oh, you need to have a much lower credit rating, because if they default, then you don't get good recoveries. But they're kind of ignoring the fact that there's very low probability of default. So we like investment grade bonds, but non-investment grade preferred to get really attractive yields, somewhere between 7 and 9. And as you implied, you get good tax treatment because the preferred stock, it's treated as stock, even though it is fixed income and senior to common. But usually you get tax benefits, either QDI, so qualified dividends. You get excess depreciation benefits, which you never get with bonds, by the way. You get 144A deductions, which is a REIT deduction for pass-through entities. All that accrues to the preferred stockholders. So you get effective tax rates closer to 20, not 40, like you would with bonds. So we think really fantastic asset class, low default rates, about 0.6% a year over the last 30 years versus high yield bonds that are closer to 3%.
Yeah, you said something interesting in there. You said senior to common. So what does that mean for people when they hear that? What does that take into account for?
Well, the most dramatic example was really the pandemic. As you remember, companies, businesses were obviously dramatically impacted. And so there was, even hundreds of dividend cuts, if you look at the whole market, of common stock, but almost no cuts, if anything, a suspension, but then a reinstatement of preferred dividends. So you get paid before the common. So there can be a common stock cut, but then a lot of the preferred dividends are what's called cumulative. So the company still owes you even if they don't pay you. And usually when that happens, they decide to not pay you because it really didn't save them any money in the long run. So that's what you saw during the pandemic. A ton of common stock cuts, almost no, at least permanent preferred stock cuts. So it's safer than just focusing on common dividend stocks.
Yeah. And when you say it's also senior in the capital stack if something goes horribly wrong in the company, right? I mean, the basis of the idea of bondholders, right, for most traditional investors has been, hey, if the company goes bankrupt, they still owe me the money back on bonds. If you own equity, the bondholders get paid back first after they sell whatever assets of the company, and then the stockholders will get paid back. But preferreds fit in again in this kind of middle ground that the bondholders, senior secured gets paid back first. And then you'd have preferred equity would have its recovery before common, shareholders get paid out on any residual value of the company or assets, right? Is that?
That's beneficial. It's particularly beneficial when it comes to utilities because their asset value is very stable and survives welfare bankruptcy. I mean, mostly you want to avoid bankruptcy with preferreds.
Yep.
You do get paid before the common, but you get paid after what's called claims.
Mm-hmm.
If there's pension claims or creditor claims. So usually you assume pretty low recoveries for preferreds except for utilities.
Yeah.
So you really want those higher quality credits where the chances of bankruptcy are pretty low.
Yeah, well, it's interesting. So let's talk about utilities for a second. I'm largely a fan of utilities. I come from a family that's done a lot of utility investment over the years. My grandpa was a big utility guy, and his investment thesis was pretty simple. He's a self-made guy, wasn't a Wall Street guy, but really liked investing in utility companies. And it was kind of a simple idea, but it's hard to commit fraud. They got to have it. People got to buy it. It's got to be a good price. It's pretty well regulated, so it's relatively safe. And so, in my case, grandpa just wanted the dividends and was quite happy with that, and a long time utility investor. Now you have a firm in particular, Infrastructure Capital, and so you guys do a lot of infrastructure investing. That's kind of been your thing. What are some of the nuances around infrastructure investment? What does that really mean? Where does utilities fit into that? And what makes that asset class attractive? And what are the challenges that can come with it as well?
Mm-hmm. Well, so we look at public infrastructure. So you'll see offerings of private infrastructure funds. Sometimes that includes things that aren't really significant, at least in the U.S. capital markets, like airports. You can put railroads in there. We don't do a lot of railroads. But where we focus is on what you mentioned, utilities, pipelines. So with AMZ as our pipeline fund, and REITs, we have a lot of REITs and PFFA, which are great credits in most cases, almost all cases. But utilities are particularly strong investment or reliable investment. And we have a fair amount of those in ICAP. We have Nextera. We have EIX, which is Southern California Edison. And the reason for that is they are primarily regulated. So in effect, the government is promising you a return on your assets. So as you indicated, most utilities pay about 50% of their earnings out in dividends. So if you get a 3% dividend yield, then they retain 50, get usually about 10% return on regulated capital. So you get an 8% total return without taking a lot of risk. And if you want to get reliable income, if you're close to retirement, want to fund your expenses with income, then utilities are a great total return opportunity, get reliable dividends, reliable growth. So really low market risk, usually about 30% of the market. So if you see all your tech stocks getting smashed, your utilities are probably going to be doing fine. So a great conservative investment to fund your retirement and sleep well at night.
What are the challenges that come with infrastructure investment? I mean, there's always a downside, right? There's always a risk out there somewhere. What are the challenges that infrastructure?
Well,
investments face?
we would say, so you do have market risk, there are equities. So preferreds have lower market risk, like about 0.5%, like PFFA. Market's down 10, be down 5. But if you're in REITs or even utilities, like during the pandemic, utilities got smashed totally irrationally. Like, so the betas are normal, or the market risk normally about 30%. But because people liquidated everything, they went down 100, just the same as the market, which is a huge buying opportunity, but very disconcerting while it happened. So equities are equities. If everybody's flushing their equities, they will go down with the market, even though they really shouldn't because they're very stable. So market risk is really the biggest issue. Also with preferreds, like they're senior to common, great issuers, great credit, good to great credits. Shouldn't go down just because people are flushing all their portfolios, but they do. So it's really market risk more than you can have regulatory problems, fires. EIX I mentioned does have a fire overhang. We think reflected in the stock. But so there could be certain natural disasters that disadvantage utilities. But usually, like in Florida, they have a big hurricane fund. They do have a fire fund. So normally not a big issue. It's really more market risk. And with utilities, if interest rates go to infinity, they're not going to do well. So you do have some interest rate risk.
Well, yeah. Okay. Interesting point. What do you mean by that? Like, so if interest rates go to obviously not infinity, but let's say interest rates go up significantly, like we get back into not even necessarily a hiking cycle. I think right now, who knows when somebody's listening to this, but we're filming this in late August of 2025. And the Fed is projected to cut rates. The current, political environment is President Trump is really kind of hammering on them to do so. And the bond market has been, as Donald Trump would call it, a little yippy. And some people are thinking there's a potential that the long end of the curve, goes up, right? So long dated interest rates actually increase as the Fed lowers interest rates. That's a scenario people have a concern about. So I think it's a valid topic. Why does interest rates going up have a negative impact on utilities or infrastructure investments?
Right. Well, so not that we're all knowing, but normally long-term rates track not necessarily the Fed funds, short-term Fed funds, but they do track roughly 100 over the expected term. It's called terminal rate, or rate where the Fed will ultimately cut rates. And that's been very reliable. There was a misunderstanding. The Fed cuts rates, short rates, and then long rates went up. But what was missed in most of the dialogue you hear on TV is that what happened is the Fed cut rates, and then they got super hawkish, and then the bets on the long end for Fed funds went up, and then 10-year treasuries tracked that, about 100 over that rate. So we strongly believe that inflation is already contained, actually mismeasured, but contained, mismeasured by, not surprisingly, the BLS, which is kind of 50 years behind in how to collect data. But we strongly believe inflation is contained. Tariffs are one time, should be ignored for the purposes of making monetary policy. Not great if you're paying them yourself, by the way, so we recognize that. But so we're bullish on it, but we're really good at forecasting macro, but we're not all knowing. And so if they do go higher, most investors will then rotate out of infrastructure, old economy, utilities, REITs, and they'll buy tech stocks because they're perceived to be more based on growth and not really, the interest rates don't matter as much. And that continues in this market. Now, most investors are assuming both short and long-term rates go down. small caps do well, old economy does well, utilities do well, even um, even like consumer staples like Coke and Philip Morris and Johnson on the drug side do well. But if rates go higher, you want to be in tech stocks and not in the old economy and not in these dividend stocks.
Yeah. How does that play through in the price of preferreds? Because all being equal, right? If you buy bonds when they're at a 4% yield and rates drop to 2%, the price of your bonds appreciate quite significantly. Is that a similar dynamic in preferreds?
Yeah. So the way to think about it is preferreds higher yield bonds are an interesting asset class because they have a little bit of interest rate risk, like about 30%, and more stock market risk, like 50. Investment grade bonds are more the reverse, like minimal stock price risk. So BND, we have a fund, BNDS. We're a high yield fund. BND is an investment grade bond fund with a yield of about 4. Ours is 8. So when rates rise, BND gets smashed. BNDS just gets impacted a little bit because most of the return comes from spread. Spread tends to tighten when stock market's doing well. So you get less interest rate risk with BNDS or PFFA because of the spread. You get more stock market risk, but it's a nice mixture. So like stock market could be up and then down and rates are up and down. But meanwhile, you're getting paid 8-9% yields. So in most markets, you're going to get pretty attractive total returns. But certainly when rates are rising, it's a headwind.
I think one of the things you mentioned earlier that I wanted to revisit was the capital gains treatment of dividends that come off of preferreds, right? So in preferreds, you have this equity coupon payment. That's kind of an obligation of the company, very similar to a bond having an obligation to pay you. But where the bond is interest income on a tax return, the preferreds have the opportunity after a period of time to, based on your personal holding period, to become qualified dividends. And qualified dividends, the interesting part about that is they get taxed like long-term capital gains. So if you look at your tax return and say you are a kind of a mid-tier income individual trying to work on retirement, or you've got some RMDs coming out, or an annuity or a pension, some Social Security income, or even rental income, whatever it might be. If you're like below that, I'm trying to remember where the bracket is exactly for married filing jointly, but I want to say it's around like 97,000 in net income. If you're below that, your long-term capital gains rate is like 0%. So now you have the opportunity to potentially pay no federal income tax on your qualified dividends out of a preferred share. Whereas even a high yield bond that paid 8, if you were in a 20% effective tax rate, you would give up essentially or 25%, so 1.75 to 2% of that would essentially just be tax, right? So it kind of really can diminish your return. Now, if you're an extremely high income earning individual, you get the same sort of advantage because you have a 20% capital gains rate is the highest rate on capital gains, long-term capital gains. Whereas the highest marginal bracket on income is it 34 or 37? I can't remember. 34.
I think 37 depends on whether you do voluntary tax, but I think it's 37.
Yeah, 37.
Voluntary tax, yeah.
Yeah. So you just end up with still a less taxes coming out of the yield. So I guess what I'm really highlighting is, even if the important thing to calculate is, okay, if I can get a little bit lower of a risk profile in something like high yield bonds, or I can get the same kind of yield, but there's technically this little bit of increased risk or perceived risk from it being this equity kind of component, and they give the same yield, it's not the same yield, right? After you pass it through net of taxes, right? You get an additional advantage. Hey, thanks again for following along with us on the Ducharme Wealth Management podcast. We really genuinely appreciate your support in the project. Please, if you haven't, like, subscribe real quick. It does help a lot. And if you have questions, you want us to take a look at your own situation, you want us to take a look at an investment statement, you want to run some advice you're getting somewhere else, just pass another party for a second opinion, you're trying to dial in your retirement plan, whatever it may be, please reach out to us. We are always happy to do consultations for our listeners. You can find us at ducharmewealth.com. From there, you can schedule appointments with advisors that you think you would like to work with, including myself or Carissa in St. George. And we can help clients, again, across the country, pretty much all 50 states. So please don't hesitate to reach out. We'd love to see if we're a good fit and can add value to your financial life. ducharmewealth.com, and we will see you out there. Enjoy the rest of the show.
So bonds fully taxable, we usually use, which is just to simplify things, just assume you're a high taxpayer. And so you pay 40% on bonds, about 20 on bond interest, rather 20% on preferreds, either because of qualified dividends or, as I mentioned, strangely, it doesn't really make sense, but it's just the way the tax rules work. You get the benefits of excess tax depreciation or even deductions like 199A deduction. So like PFFA, roughly effective tax rates 20 for high taxpayers, high income taxpayers, and 40 for bonds. So definitely get, and by the way, default risk way worse for preferreds, but the income's about the same as high yield bonds. So arguably, preferreds are superior to high yield bonds, but to be fair, they have lower equity risk. So BNDS is our high yield bond fund. You don't want a lot of volatility, particularly if you're in a non-taxable account like an IRA. BNDS could be very attractive. For taxable accounts, PFFA, probably more attractive, similar risk, a little bit more volatility, but way better after-tax income.
So it's definitely an interesting asset class that a lot of people are not. I think it just gets overlooked. What is there anything else that you care to share around preferreds or infrastructure investing that you've learned throughout your career that you find really interesting?
No, just that it is active management's really essential. We manage interest rate risk, call risk, credit risk, as we were discussing, and also we can arbitrage the passive index funds. So they can't do new issues come, and then we participate, and we sell to them at higher prices. They have to rebalance every month. They disrupt the market, and certain preferreds get overvalued. We sell it to them. Other ones get undervalued. So if you look, our returns are extremely attractive. You do your own work, but arguably the best for both fixed income and preferred stock ETFs. And so you can do that yourself, but it's a lot of work. We have a big team that does analysis on all the preferreds. We do trading every day to optimize it. So active management is critical for preferreds. You can do it yourself, but there's economies of scale. PFFA is a $1.8 billion fund. So we can spend a ton of time and energy and analysis on the funds. So typically, we beat not only index funds, but even probably what you could do on your own.
Yeah. It's interesting, the conversation around active management. One of the things I've learned is, I came into the industry and going through school, it was really interesting. There was a big push around really great quality fundamental analysis, but also really interesting dialogue around index funds are, just the way that portfolio should be made these days kind of idea, right? That was kind of always the underlying tone. And that is largely the underlying tone of most of the financial planning community. I think a lot of people are looking for that. It's certainly the most prevalent at this point in the 401k space. And I think there is a case to be made for better or for worse in particularly US large cap, right? Where there is an argument to be made that it's potentially more efficient markets, right? I think there's a deeper argument around indexation and passive investing effects. But I guess what I'm trying to highlight is, even if you concede that, okay, in there, passive investing or just tracking a passive index is maybe makes the most sense. Maybe one of the things that I've come to find is if you're going to spend money anywhere on a portfolio, right? Find the segments of the market or the parts of portfolios where active management, if you really dig in, starts to have an outsized effect, right? Like what are the parts of a portfolio where active managers can add the value or have a likelihood to add the value? One of the ones that's easy to point out is generally bond managers, active managers of bond funds tend to beat the benchmark, right? More than half of them beat the benchmark. So you generally are going to be well served by trying to identify a high quality active manager in the bond space. And it sounds like preferreds is maybe one of those areas, right? Just like alternatives is one of those areas. Privates is, one of those areas. So you really can't track a passive index on privates, but identifying a good manager certainly is important. Is that like what makes preferreds a part of the market that it's worth considering, paying the fee for active management on? Like what provides edge to an active manager of preferreds?
Mhm. Well, so we're sympathetic to the argument, particularly for large caps, that passive can be better than active. And the dynamic there is that you have cap weighted indices and with equities, but not fixed income. It's not terrible to do cap weighting because you end up buying more of the companies that are doing well and owning less of the ones that are doing poorly. And that works pretty well. Now, I would say we have a large cap fund, ICAP, but we're not just picking stocks. We're also writing very short-term covered calls. So we think we add a lot of alpha there. And so that fund has done well, and arguably, our data shows better than like the equal weighted S&P. But the real point there is that it's not terrible to do cap weighted because you get the momentum, and sometimes active managers will say, oh, well, GameStop's terrible, but it does better. So it's a little bit unpredictable. But fixed income's different in that it's callable at par. So doing momentum trading is terrible. You should sell it when it goes above par, which the index funds don't do. You don't want to make credit mistakes because it can wipe you out, but your upside was limited. And you do need to manage interest rate risk. And then there are these ways to arbitrage the index funds that don't exist with equities, like doing new issue and also taking advantage of their rebalancing, which is kind of doing the opposite of what they should do. They're selling their losers and buying the gainers, but ignoring the fact they're callable at par. So you get completely different dynamics with fixed income. So it really almost requires active management. On the equity side, we're sympathetic to your view that it's could be cheaper and better to do passive management with this exception of adding these active value added, particularly writing very short term bespoke covered calls.
Yeah. Really quick, like help the listeners understand when something gets called away at par. What does that mean in essence, or why is that good or bad?
Well, it's possible if you do a lot of work to reasonable, like Barron's has a screen of preferreds. You can go look, say, AT&T is preferred. Oh, wow, it's yielding 7. It's fantastic, but it's trading at 26. But what Barron's doesn't tell you is it's potentially currently callable at 25. So you think you're getting 7, but you really lose a full dollar if it gets called. So you have to be aware of that dynamic. It's possible to do it on your own. It helps to have a Bloomberg or other data source to figure out when the call date is and what the yield to call is. So it requires bond math. It's not that easy to do, but you have to be aware of that risk factor.
So essentially what you're saying is, in your case, just as an example of an AT&T preferred trading at 7, or 7% yield trading at 26. So you could take $26 of your portfolio and go buy it today and be like, woohoo, I just locked in this great yield. I think AT&T is a great company. Their credit rating is good. They're not going anywhere. So I'm just going to sit on this and collect up 7%. And then the next day, AT&T is like, here's $25. We want our share back. And you're like, what? How did that happen? And it's because par was 25 and it was callable, which means they could redeem it and give you your $25 back. Whoever the current owner is at the time, they could give you the $25 back and take it. And so if I'm understanding what you're saying correctly, is that in the active management space, particularly with preferreds, a lot of times they can trade up over par, and maybe even the indexes that the preferreds get pushed up way over par, and the indexes, because of their construction, have to buy more of the stuff that's over par, and they got to sell the stuff that's gotten cheap, that isn't callable and can lock in nice yields. And so you can, as an active manager, kind of work that system, right? And kind of trade against them.
So we're able to sell our preferreds well above par. And you might say, well, who in the heck is buying it? Well, when they get inflows, they don't have smart beta elements like we actually do in our index fund, PFFR. So if the yield to call is below 3, it gets eliminated from the index. The big index funds don't have that. So either if they get inflows or when they're rebalancing, they just go and buy these securities above par that are, you can have negative yield to calls, so you can lose money, or at least really low yield to calls. So we're able to take advantage of that, sell above par, recycle into below par. And of course, this doesn't exist with equities. Like Google's not callable at 200 or NVIDIA's not callable at 180. It's not fundamental to the company. If you write a call, you can get called. But so it's a risk that you have to manage, but doesn't exist with equities, but does exist with both debt and preferred stock.
Yeah. Well, it's certainly some interesting dynamics to understand. I think it's a really interesting part of the market that people just don't talk about. And I think a lot of people just think it's sort of a boring part of the market, but sometimes that can be the greatest spot to find returns, is in the boring parts of the market that no one else wants to talk about, right? It's like kind of the old thing, like no one thinks it's glamorous to own laundromats till you see the P&L of the guy that owns all the laundromats, right? And all of a sudden you think it's more interesting than it ever was, right?
Well, there's a dynamic there that people often forget. So I actually got this question just literally last night from a high school friend that I help him manage his own portfolio. And he said, well, yeah, I'm really thinking about selling some of my really conservative bond funds and buying, tech, particularly growth tech equities. He knows that pretty well. And, should I do that? And I said, well, yeah, that's fine as long as you don't need the money. Well, one of the reasons he doesn't need the money is he does have some of our funds, some higher risk, fixed income, BNDS, quote, higher risk, and PFFA, 9% yield. So that covers the majority of his expenses. So when you're older, what you don't want to do is say, oh, I'm going to be all in equities, all like NVIDIA and Broadcom. And then the market takes a big spill like it did during the tariff tantrum, and you need the money and you have to sell. But if you have income securities like preferreds or like PFFA, it's paying you every month, then that can cover a lot of your expenses. And then that mitigates your need to liquidate the rest of the securities. So you can actually take more risk with the rest of your portfolio and get better long-term returns, knowing that the bulk of your expenses, or at least a portion of them, are covered by income. So I think investors ignore income, not recognizing that could give them more security and actually even more ability to get better returns because they can take more risk with the rest of the portfolio.
That's the old barbell approach, right? If you cover the needs with conservative, then you can, what you want to do is take a lot of, not a lot, but you want to take risk with the other portion of the portfolio.
Right. You don't have to have utilities. You can have Broadcom. You have to look, if you have a small portfolio and big expenses, that's not going to work. But a lot of investors I talk to are older. They've inherited money, they have IRAs. And so really, and they don't have big lifestyles. They don't live in New York City like me, unfortunately. Don't have 4 kids. And so you really look at it and say, oh, you got a pretty big portfolio like this high school friend. easy to generate pretty good income. So you really aren't likely to need much more than your income, so you can take more risk for the rest of your portfolio.
Yeah. Yeah. It's a interesting thing that I think people don't talk about enough in the planning side of portfolio construction, right? Because portfolio construction isn't always, simply, I want to find the efficient frontier and buy that combination of assets. Because at the end of the day, that doesn't take into account an individual investor's need for what they really need out of their portfolio once they consider their life circumstances.
And also there's just practical considerations. Like I know, and actually even I eventually are going to have this problem. There's something called RMD. So you have to take money out of your IRA. Well, that generates taxes. And also, if your IRA is all in tech stocks, then you would have to go sell them. And you just have to do it every year. So it might be not the greatest time to sell them. So if your IRA has some income securities, you can take that cash, use it for your R&D and not take liquidation risk, if you will, of selling at the wrong time.
Yeah.
So there's practical considerations that favor having some income. And of course, income doesn't pay tax in IRAs. So, R&D taxes and reducing your risk of having to sell at the wrong time does argue when you're older or even planning to be older to at least building up your fixed income securities over time. And also, even if you're super young, the market takes a spill and you've got lower risk fixed income, you can rotate out of fixed income and buy more of the higher risk securities. So there's a way to use it in your portfolio that can enhance your long-term returns and lower your risk.
Those are all, I think, really good points. Do you mind if we just pivot the conversation really quick to a macro conversation? For anyone that is still listening to the podcast at this point, they probably are also interested in is like what's going on in the economy right now. And Jay, you tend to have some interesting thoughts about the macroeconomic environment. I'm just, if I got you, if I've gone through the effort to get you on the phone here, get you on the line, I got to at least ask you what your take on stuff is.
Well, we have a lot of proprietary research. So the two big insights we have now are one, inflation's already contained, which you won't hear from the Fed. You have to correct shelter for real-time shelters inflation. The BLS waits 6 months to update it for no reason, just they do. Mm-hmm. And then they use data series that are lagged by another year and a half. So we publish this on our website. PC cores about less than 2, CPI cores like 1.2. So we do think the Fed will cut. And the reason they're going to cut, this is the second insight, is that the old economy is in recession, as you would expect during Fed tightening cycles. Normally you have a recession. The housing sector leads it, and it is here as well, and construction. But the housing sector is less cyclical because we didn't have the big booms that we've had in the past because of the great financial crisis. We haven't had a big increase in housing, so the bust is very slow and mitigated by the fact we have a shortage of housing. So you have slowing but not crashing housing, and then booming tech, but not just software and computers, but also chip plants, cloud infrastructure, and the electricity required to power those data centers. So a unique economy, half in recession, half booming, slowing, but not crashing, slow enough for the Fed to cut, lower rates, strong enough to keep the stock market stable. So not even almost, a Goldilocks situation. But it's important to dig in to the underliers. And also, last insight, everybody obsesses about the consumer, but they don't realize that every recession since World War II, every recession was caused, number one, by the Fed tightening, so they don't magically occur. But secondly, by an investment bust, because the Fed acts on investment. 12 times in the housing sector. The last time in early 2001, it was just the tech bust. Not a very deep recession because they didn't have all that infrastructure. It's just really software. But so key insight, not the consumer, but actually investment. So watch investment. It's relatively stable, but the Fed needs to cut. They are going to cut. There's going to be more Republicans coming in that are less focused on this expectations theory of inflation, more focused on tariffs being one time. So very likely to get cuts. Likely the stock market continues to do well. So really Goldilocks for a balanced portfolio.
Hey, it's no secret to us. We look at the demographics of this show. We know that a lot of you listening are actually other financial professionals and other investment advisors. We want to go ahead and invite you. If you're looking to do something different in your career, go ahead and reach out. We're always looking to bring on high quality people that understand how to do the planning process, align with our values, and are looking to deliver high value to their clients. Please just go ahead and reach out to us. You can get us on our website, ducharmewealth.com, and we look forward to talking to you. I can always count on you, Jay, for a non-consensus view. that I can do. The way that you look at it really, it's always interesting to talk and listen to you, because it's although you're oftentimes on, CNBC or Fox Business or wherever, you very much don't have the same opinion of most of the people that get on and provide commentary. So for that,
I just say quickly too that we're getting better about representing the data because, a lot of times I write up complicated notes and send them to the media outlets, but we're doing better graphic representation. You can get that on our website. So you'll see like the chart of the money supply. You'll see the chart of how investment has declined on the real economy, but it strengthened. And you also see the chart of the housing sector and how it's become less cyclical. So we're trying to get better and not communicating our opinions, but the data so you can come to your own opinions.
Where what's the website? Where can people find that, Jay?
www.infracapfunds.com. And if you can't find it there, you can send emails. Like we love talking to our clients. So you can directly email me unless I'm, gets caught up in my spam file, which I normally wouldn't. Then I'll respond to you. I can tell you where it is, or I'll send it to my people that can send you the slides.
Sure.
So again, the data is critical. There's a quote from Deming, who was a famous advisor to manufacturers, particularly in Japan. Data without opinions is worthless. It's really the data that's critical. And so we provide that on our website. And we do a ton of work to back up our opinions. And that's why, not humbly, why we've been very accurate in our forecasts.
Yeah. Well, I appreciate you taking the time and sharing all that with us, Jay. For anyone interested more in Jay's funds, you can find him on his website. Reach out to me. I'm happy to take a look. Do a lot with portfolio construction, helping people get the portfolios that they need to not only give them the returns and build them for that, but also marry that with their personal financial situation and really what they need from their portfolios. So reach out to us at ducharmewealth.com if you're interested there. And we look forward to seeing everyone out there. Jay, thanks again. We really appreciate you.
Great. Thanks for having me on. Great questions and great conversation.